98% of investors underperform the markets, but not for the reason you might think. It's not because they pick bad investments. According to decades of Nobel Prize-winning research, there's a simple mistake that stops you from building life-changing wealth. But once you understand it, investing becomes completely different. So, in this video, I'm going to show you why most investors underperform even when markets are going up, and the 9 Nobel-backed principles that can help you invest smarter. Section 1. Why the average investor underperforms. Now, to start with, I want you to imagine something slightly abstract, but it will help you visualize the mistake that most investors make. So, I want you to imagine that you're going up an escalator, and in your hand, you are bouncing a yo-yo. Imagine the yo-yo leaving your hand, falling down and flying back up again, over and over and over. Now, if all you do is stare at the yo-yo, it might feel chaotic. But if you zoom out and look at the bigger picture, you'll notice something. The escalator is still moving upwards. Now, I said it was abstract, but this is exactly how investments look. The yo-yo represents short-term market movements, the daily ups and downs that many investors obsess on over and over. And the escalator is your long-term wealth. But here's where the average investor goes wrong. They focus on every dip, every swing, and every headline. When markets drop, they panic sell everything, waiting for things to settle and then try to time when to get back in. When markets go sideways, which they can do for very long periods of 2 years or more, they typically get bored and frustrated. Many people convince themselves that their strategy isn't working and fixate upon whatever is hot right now, only to discover whatever is hot now typically goes cold, and they should have just stayed more patient with their original strategy for longer. So all they're really doing is buying high and selling low over and over again. And this is exactly why 98% underperform the market. So how do you overcome this emotional trap? Well, you need to reframe how you think about investing. Right now, most people see investing as a series of speculative short-term bets. But the real investment isn't in the market, it's actually in you. Your future, your goals, and your ability to live the life that you actually want. And that kind of wealth isn't built over months or even years, it's built over decades. Yes, there will always be times when the market goes up and down just like that yo-yo. Some days will feel great, and some days will feel awful. In other words, when the markets are high, we can typically feel happy, and when they dip, we can feel unhappy. This is just human. Average investors will have a bad experience because they act upon these emotions. As markets are doing well, people typically pour money into the stock market, and then as they dip, guess what happens? They start taking that money out, and then the reverse happens time and time again, over and over. Most investors are buying high and selling low. Now that's not wealth creation, it's wealth destruction. But if you can step back, zoom out, and stay the course over a period of time, then that's proper investing. And you give yourself the very best shot at success, because in the long run, the escalator always moves up. So what steps can we take in order to become a confident, calm investor instead of an emotional one? Well, that's where our 9 Nobel Prize-winning principles come in. Principle 1. Every single day, over $784 billion of capital moves through the world's stock markets. Millions and millions of people making millions and millions of trades. And with every single trade, a buyer and a seller are doing something very important. They're setting prices. If a company announces record profits, then that gets priced in immediately. If a chief executive resigns, the market reacts within seconds. Before you've even finished reading a headline, the market has already adjusted. The stock market is an extremely efficient place. This means that no single person, no matter how smart they are or how many books they've read, can consistently know more than the collective knowledge of those millions and millions of investors. This is why emotional investing and market timing rarely works. So instead of fighting prices, you can work with them. We call this embracing market pricing. It means that you accept that the market is highly efficient and you pay a fair price on any trade at any given point in time. And it's the foundation for building a truly successful investment strategy. And if you want to learn more about this strategy, you can download the Expat Investment Guide in the description. Principle 2. Now, research shows that over the last 20 years, only 18% of equity funds have survived and outperformed their benchmarks. This tells us that most professional fund managers, despite their research and their fancy financial models, can't consistently beat the market. And yet the financial industry keeps selling the idea that you can. They suggest that with the right analysis, you can somehow predict where the market is heading. Well, let me be the one to tell you this isn't true. Markets are just too efficient, and there are too many things that can change in an instant. So my advice to you is this: stop trying to outguess the market. Instead, stick to a strategy that works over decades, not days. Principle 3. Let's say you're looking for a fund to invest in, and you check out last year's top performers, and you find a particular fund that crushed the market and delivered amazing, huge returns. The manager's currently all over the news and everyone's talking about just how well they did. And you think, well, if they did this well before, surely they'll keep on doing it in the future. So you invest in their fund, and that makes sense, right? Except this is another reason why the average investor loses money. Because if you look at the top 25% of funds in any given period, only 22% of them stay in that top group over the next 5 years. Most drop back to average returns, while some completely fall apart. In fact, it's often hard to distinguish if its outperformance is down to skill or just dumb luck. But by the time most investors catch on, they've already poured billions just as those funds start to decline. So if your goal is to be better than the average investor, you have to resist the huge urge of chasing performance by all possible means, so you don't end up playing a never-ending game of catch-up. Principle 4. If you invested $100,000 into the great companies of the world, over 30 years, earning 8% return, it would have grown to $1 million, even with all the crashes, recessions, and the crises over these decades. This is because when you invest in the stock market, you're buying real companies that create real products and services and generate real profits. And over time, these great companies of the world work tirelessly to grow and become more and more valuable. Sure, some of them fail, but overall, the market has consistently and handsomely rewarded investors who stayed invested. So, if you're going to be better than the average investor, you need to focus on capturing these market returns, not trying to beat them. Principle 5. This brings us to an important question. What actually drives these returns? Well, the research shows it comes down to just two very simple things. Number 1, what investors will pay for an asset today. 2, how much value that asset will generate tomorrow. That's it. If you can structure your portfolio around these proven drivers of returns and not market predictions, you'll be far ahead of 99% of investors. And this is exactly why using peer-reviewed academic data and not spin or news channels to make sensible capital market assumptions is just so critical to your future. Principle number 6. This brings us to another interesting point, because those returns don't just come from one place, and a lot of investors think that they're diversified because they own a mix of stocks and bonds. But if all of those investments are in the same country or the same sector, then that isn't real diversification. No single market leads forever. If your money is stuck in just one place, you're relying much too much on one set of risks. But when you invest globally, you're not just depending upon one country's success. You're tapping into growth wherever in the world it happens. And over time, that balance or global diversification really will help smooth out the bumps and keeps your portfolio always moving forward. Principle 7. After diversification, the next challenge is actually just sticking with it. Because like I've said before, the biggest mistake investors make is trying to time the market. And they always deny it. But market timing is natural, hardwired evolutionary behavior. And like I've also said before, this does not ever work. So here's my advice. Stop trying. Train your mind to stick to a sage, wise, systematic strategy over very long periods of time. And by this time, I mean decades. Principle 8. I know this is easier said than done, especially when you're constantly being bombarded by different headlines. Markets are crashing. A stock market is about to boom. It's exhausting, and for investors it can be very dangerous because the headlines aren't designed to help you invest successfully. They're designed to get your attention and to trigger fear or excitement. And when you let the news dictate your decisions, you fall right back into your emotional investing and potentially market timing. So instead of reacting to every dramatic headline, focus on what actually matters, your long-term financial life strategy and the plan, because the news will always change, but the principles of successful investing always stay the same. Finally, if there's one takeaway from everything we've talked about today, it's this. Most of what happens in the market is completely out of your control. You can't control when the next recession hits, or what stock market prices will do tomorrow, next month, or next year. But you can control how you invest. You can control how diversified your portfolio is. You can control how much you save and you invest over time. You can control how disciplined you are when markets get rough, and you can control how much you pay in total aggregated costs versus sensible benchmarks and what exactly you're getting in return for these fees. And that's where the difference is really made. Those investors who focus on what they can control are the ones who build true wealth. This is why having the right strategy, the right mindset, and the right guidance is just so important, because good investing is about making smart, consistent choices that set you up for success. And when you do that, you give yourself a good shot at long-term financial freedom. But you also need to remember the other 8 domains of sensible financial life management that help successful families truly prosper and thrive. So we've covered the 9 key principles that separate successful investors from the rest. But time, patience, and discipline aren't the only levers you can pull to improve your results. There's actually another factor that's hugely overlooked, and that's the overall mindset you have towards money and building wealth. So check out this video next to learn how you can start thinking like a wealthy investor that you want to become.